Hey everyone, welcome back to the Nail Hub YouTube channel. I'm here with Monica Felton, certified financial planner, and the expert who is sharing all of her knowledge as part of this financial university series that we're doing together. Monica, I'm so excited for class 4 today. What do we have to cover?
Well, today we're going to cover probably everyone's least favorite thing in the world, which is taxes. But it's a really important concept to understand because you have to pay your taxes, but you don't want to overpay taxes. So we're going to touch on that. We're also going to talk about qualified plans. Qualified plans are those things like 401ks, IRAs, SEPs. It's really a government savings program. So I want everyone to truly understand what that is. And lastly, we're going to cover inflation. Um, well, since COVID, there's been so much talk about rocketing inflation. And so I want your viewers to really understand, what is inflation? How does that impact them? So we've got lots to share today.
Sounds like good stuff. All right, so I'm going to give you full screen.
Perfect. All right. So last week we left off because remember, when you're saving for your future, you have choices. And the choices you have are based on risk, your risk tolerance, how much are you willing to take? The second piece is taxes, because trust me, if you have any gains anywhere, the government wants their taxes. And lastly is liquidity. So today we're going to jump into the tax portion of future savings. So let's get started. Here we are back at the personal economic model. And if you recall, last week we went over risk, right? Risk is the ability to earn, but also to lose. So what we're going to talk about today is taxes, because taxes are an important piece. If you recall, you're going to earn income and it comes in through this big bucket because that represents all the money you're going to earn over your lifetime. And then what do we hit? We hit the tax filter. Now, every person's personal economic model has this tax filter bolted on. We don't have a choice. You have to give the government taxes or there's very, very bad consequences. So let's first start with income tax so you understand that piece. All right, income tax, that's that April 15th that comes around. The government wants you to fill out your tax forms or your tax returns. And you have to fill out a status. So there's either married filing jointly or there's a single taxpayer. Now, remember, your gross income, that represents all the money that's coming in through your fingertips. It's either earned or it could be your tips or it's investment income, but that represents your gross income. Then the government gives you something called a standard deduction, and the standard deduction actually reduces your taxable income. So you see $50,000 of gross minus your standard deduction means that your taxable income is about $36,000 if your gross income is 50. Now, what that means is that on this $36,000, you're going to owe about $4,118 of tax. Now, in this country, we have something called marginal tax brackets. And what that means is that you're not paying taxes on this entire $50,000 at, the 12%. The marginal tax bracket means the highest bracket that you're in. And in our case, in this example, $36,000, that would put you at the 12% taxes. That is your marginal tax bracket. That's why you see the 12%. But then there's something called effective tax. And what effective tax means is how much money are you giving the government of the $36,150? And so what you see is you're giving them about 8.2% of your $36,000 of your taxable income. So if indeed I made more money, right? So let's say I made $150,000. Now, all of a sudden, my standard deduction, it is the same. Your standard deduction does not change no matter how much money you make. Now, in this example, this is a single taxpayer. but I can change that to be married filing jointly. I get a higher standard deduction, right? So my taxable income reduces to $122,300. But if my situation looked like this and I was making $150,000, I am now in a 22% marginal tax bracket. And what that means is that every dollar I earn over $89,000 up to $122,000, this number right here, I'm giving 22%. But then every dollar from 22,000 up to 89,000, the government's only taking 12%. So that's how we get to the effective tax rate of only 11% or 11.7%. So understanding income tax matters. And the reason I want you to understand income tax is so you have an understanding of how much money April 15th you're going to have to send to the government, but it should also impact the investments or where you put your money. All right. Liz and I had a conversation last week about expenses and how to make sure if you're going to spend money for your business, it's truly a business need. Because I hear all the time, oh, well, it's a deduction for my business. So I want to show you that if you're making $50,000 a year, and let's say you have $10,000 of business expenses. If I'm paying $50,000 a year, my taxable income is $22,300, and I'm paying $2,236 in taxes. With my business expense of $10,000, that's going to reduce my my gross income to $40,000, right? $50,000 minus the $10,000 in expenses is $40,000. That drops my taxable income to $12,300. And now my tax is $1,230. I basically, by spending $10,000 on expenses, right, I drop my tax by $1,000. So please make sure if you're going to spend $10,000 on expenses, remember that you're not getting $10,000 back in taxes. You basically saved $1,000 in taxes, not the $10,000.
I think that is so important, again, for people to understand, because so many people, especially sole proprietors like nail technicians, they will run all kinds of expenditures through their business. And, when I used to do consulting for salons, I would see this time and time again where people were running all kinds of personal things through their business, hoping that that was going to somehow, magically make them earn more money. And at the end of the day, it really doesn't move the meter that much. And you're still sacrificing a ton of capital that you could have done other things with. And you're just, again, justifying the expense with something else. So I really like that you demonstrated that, because it does visually show what we were talking about with, make sure that if you're going to use a dollar, that it goes towards something very strategic and very purposeful.
Right. Yeah. Don't let the tax wag the dog, so to speak, right? Don't let the tail of tax justify you buying things that you don't need. All right. So now that you understand income tax, let's talk about this thing called a qualified plan. Now, any of you who have seen a CPA or need a CPA for tax purposes, they usually will encourage you to invest in something like an IRA, a SEP IRA, a simple. These are all what we call qualified plans. And these are different than after-tax investments, because what happens is we actually earn the income, but instead of coming down through the tax filter, we actually bypass the tax filter and put money into those qualified plans like a SEP, a 401k, or an IRA. So we earn the money, it comes down, avoids the tax filter today, and then it's deposited in a risk investment. Now, 401ks, IRAs, and SEPs, they all are at risk. They are invested in the stock market usually, which means the account can go up or the account can go down. And if you want to be reminded about risk, you can watch class 3 where we talked all about risk investments. Now, what happens with a qualified plan is we don't pay taxes during the growth of the account, right? So this is a government savings plan and it's meant for retirement. So after 59 and a half, you actually can get access and begin using the money. So we would pull the money out, but that's when it hits the tax filter at withdrawal, and then you can spend the money on whatever it is you want. So this is the picture of how the money moves through your circle of wealth. So let's understand qualified plans a little better. So what is a qualified plan? As I mentioned, it's a government created savings plan for your future, for retirement. And because the government has created it, there's many rules and regulations. Now, you might understand qualified plans to be a 401k if you work for a corporation. A SEP IRA is very common in small businesses. So is a simple IRA. A 403B is what's used if you work for a government, if you're a teacher or a fireman or something along those lines. But all these plans are very, very similar. If you choose to put your money in there, there are some tax incentives. So qualified plans, they really do two things. They defer the tax and they defer the tax calculation. Remember, your contributions into these qualified plans are made with never taxed money. So you postpone paying the tax. You actually don't, well, we're going to get to that. You don't really save any taxes, you just postpone them. But when you do that, you postpone the calculation, which means you have to think about what tax bracket are you actually going to be in retirement. So if you're 20 years old or 30 years old or 40 years old, do you have any idea what the government will be charging you in taxation 20, 30, 40 years from now? And the other is, what deductions will you have? Remember, we talked about business expenses being a deduction, but in retirement, are you still going to have your business? Likely not. So let me give you an example of how a qualified plan really works. I'm going to use that same $5,000 a year number of savings. And again, we're going to assume you're making $50,000-ish a year, which would put you in a 12% tax bracket. I'm going to say that we're just going to a guessing game that when you withdraw the money after 59 and a half, that you're still going to be at a 12% tax bracket. We're going to wait 30 years before we do that. And then I could earn an investment rate of about 5%. So if I did all these things, how much money would I have? Well, good for you. You would have an account where there's about $350,000 in there. But please know, not all that money is yours. You have a partner in qualified plans called the US government. So your share of that $350,000 is $307,000. That's yours. And what's the government's? Well, you owe the IRS about $42,000. Let me help you understand that you postponed giving the government $18,000 so you could turn around and give them $41,000. Now, does that make any sense at all? Did you save taxes at all? We do not save taxes in qualified plans. We postpone taxes. And the reason is because the government is smart and their retirement plan is the same as yours. So if I change your investment rate of return to, let's say, 10% instead of 5%, the good news is your balance went up. It went up to almost $1 million. Your share went up, but so did the government's, right? In essence, you postponed paying $18,000 in taxes over this 30-year time frame, so you could turn around and give the government $108,000. That doesn't seem right to me. Now, what everybody says is, but guess what? When you're in retirement, you're going to be in a lower tax bracket. So let's play those numbers out. So I am basically contributing money into my 401k at 12%. And let's say I did, make less money. Now, remember, for you to drop to a 10% rate of return, a 10% tax bracket, you're going to have to make less than $22,000 a year. $22,000 a year. Who can live off of that? Right? So let's just say that you did retire in a lower tax bracket, right? Let's go back to that 5% rate of return on the money. So you have $350,000. Your share went up, so you get to keep more of your money. The government shares went down, but look at this. You still postponed only $18,000 to turn around and give the government almost $35,000, almost double that. So please know, government or qualified plans are government plans, and they're in it for the money too. Now, this chart here is a chart of the top federal tax brackets. So remember income tax, and remember that top bracket is called the marginal tax bracket. So if you can believe it, we did not have income tax prior to 1913. That went on the books as a temporary tax. But you can see that this here is your government on crack. And the crack is the power and the money that our government gets from taxation. And it really is all over the board. But if you look at all the times the government has increased taxes, it's usually for war or social programs. So you can see at World War I, this was spiked. This here was the Great Depression. The Great Depression, we had the New Deal come out where we were pumping tons of money into the economy. And how did we pay for that? Taxation. You have to understand, the government does not make any money. The government takes money. They take money from those of us who work in the form of income taxes. So we are the ones who pay for social programs and wars and stimulus checks. All of that comes from taxpayers. And this chart is very reflective of it. So this here in the 1950s, that's the Korean War. Then over here we have Vietnam. This over here was the Gulf War. You can see that. And then, so that was really in the 1990s. But you see, we don't really have any big spikes that come up any longer. This over here was COVID. Now in COVID, the government printed $8 trillion, not million, not billion, but $1 trillion. And yet we didn't increase any taxes to pay for it. So if you're going to retire somewhere out here, where do you think taxes are going to be? Because if when you retire, taxes are higher, a qualified plan that you postponed taxes might not be such a great idea. Now, before I move off of this, I want to share something with you called the debt clock. So this here is the US debt clock, and you're happy to go over there yourself. It's just usdebtclock.org. And this is kind of our government's balance sheet. I want you to notice the first is what's called the US national debt. And what you'll see is that as a country, we're $32.2 trillion in debt. Now, I'm going to show you the difference between a million, a billion, and $1 trillion, but that is so much money. Now, that's how much we owe total. The US federal tax revenue, this is how much the US government takes from us, from individuals and corporations every year. And currently they're at almost $7 trillion. So that's a lot of money. But look over here, the US federal spending, we're actually spending $6.2 trillion, or about 35% more money than what we're bringing in. So the government actually has a credit card too. That's why this number, our debt number, continues to grow so rapidly, because the government is spending 35% more money than what they actually have. Now, what I find very interesting are our largest budget items. So Medicare and Medicaid, that's the social health insurance program for individuals over 65. We spend almost $6 trillion on that a year. Social Security, we're spending almost $1.3 trillion a year. War and defense, we're spending $787 billion a year. And then, of course, interest on debt. So those are the biggest expenditures. So I would encourage you to think about these two expenditures that we have are for our seniors. And right now, we have 10,000 baby boomers retiring every single day. And they're going to do that for about the next 20 years. And how is Social Security and Medicare doing right now? They're doing very, very poorly. And taxes are what's paying for these two things. So just a little factoid on how the government is spending money and how much debt we're actually in, remembering the government doesn't make any money. They take money from us. To help you truly understand what $1 trillion looks like, I just like to share because I think this is fun. So what is exactly $1 trillion? So I think we all know what $100 looks like. That's pretty clear. Now, a packet of $100 bills, that would lead us to $10,000. So that's what that looks like. We've seen plenty of movies to understand what that is. So now, believe it or not, this is what $1 million looks like. We could actually put $1 million of $100 bills into our backpack. To make that look a little more impressive, right? $100 million looks like a little pallet. Now here's $1 billion. So there's basically 8 pallets here. That represents $1 billion. And then let's look at $1 trillion. What does $1 trillion look like? So I don't know if you can see the little man over here, but here he is down in the far left corner. And I want you to see that all of these are double stacked pallets. So right now as a country, we're $32 trillion in debt. So when you hear the government say they're printing $8 trillion, which is what they did in 2020 for COVID, this is the kind of money that we're talking about. It's mind-boggling the amount of money that our government is printing.
I was going to add one quick thing on that, which is the one comment that I usually get when you're talking about these kinds of conversations, because it is a big pill to swallow when you start to see these things. And a lot of us also, I think, come from the perspective of, we want, from an empathetic perspective, we want to continue with social programs. We don't want people to be left out, and we want to offer the world to everybody, which I can understand where that perspective comes from. And then there's also kind of this, there's that part of it. And then there's also this, hopefully I won't have to deal with it in my lifetime. It'll get passed on to whoever comes after me, right? And I think that passing the buck thing has happened for a really long time. And I really just wanted to mention that I would encourage you guys to, in a moment, especially since we're talking about personal finances, is think about how this actually does affect you. As Monica was just saying, during your procedure of trying to retire, And again, being in the trades, we're going to be forced to retire at some point just because of simple wear and tear on our bodies, or we're going to have to do a career shift, one or the other. And I don't think anybody really wants to work until the day that they die. So thinking about that, thinking about all of this information, I just wanted to put that out there that I can understand the different perspectives and the different feelings that arise when we have these kinds of conversations, but it still has an impact on where you're going to be when you are trying to live your lifestyle for the rest of your days. And so that's really the focus here, is getting you guys to open your eyes to what the truth is and actually have some information that changes your circle of knowledge, as Monica discussed in one of our previous classes. But at the same time, you also need to be slightly selfish in analyzing your financial situation, because this is going to have an impact on you, whether or not you agree with it, or how you feel about it, or how empathetic you want to be, or whether or not you believe all of this, or whether or not you pass the buck to someone else. You're still going to have consequences during your lifetime.
Without question, there's consequences to every behavior, right? Good and bad. And what I'm hoping, because I think there's a huge misunderstanding about where money comes from. When the government's writing social programs and checks, it's like, oh, yay, I'm so glad the government's doing this. Well, it's your money. They're taking it from you. And what we're going to talk about next is inflation. Inflation hurts people who are on a fixed income, the elderly, people who are lower socioeconomically. Inflation is hurting them the most. So if inflation spirals out of control and you don't have assets or resources to combat that, right? Then you're the one who's going to be impacted the most. So that's why, remember, education provides freedom, because if you truly understand how money works and what's happening, then you get to make good choices for you and those that you love. And that's what this program's all about, is empowering you to make the best decisions you can for your family. So circling back to qualified plans, remember that government savings program for your future. I want you to understand that if you're choosing to put money into a government savings plan like a SEP, a 401k, or an IRA, you do have to ask some questions. What tax bracket will you be in when you retire? What will income taxes look like? What deductions will you have when you take the money? And lastly, what is your exit strategy? One of the rules and regulations about qualified plans is once the money goes into the account, let's say you contribute at 30 years old, you cannot access that money again until 59 and a half without penalty. The government says you have to keep the money there until 59 and a half. So understand the entirety of the investments that you're putting your money in, because as a young person, we talked about life happens, those unexpected expenses. Kids are expensive, businesses are expensive. Where do you get the money to pay for those things? And if your money is sitting in a qualified plan, right, there are some limitations to liquidity and getting access to that. As a reminder, your qualified plan is going to sit over here in your personal economic model. It's going to sit on this side of the house. Remember, you have not paid taxes, and you'll pay taxes when the money is taken out. One last concept I want to talk about is inflation. Inflation is actually the increase of prices over time. And as we record this in 2023, you have heard so much about inflation and how expensive everything is. Well, it's no coincidence that the government printed $8 trillion in COVID in stimulus checks and forgivable loans and helping businesses, etc. But now we have $8 trillion more money circulating. And what that does is it drives prices up. Inflation erodes the purchasing power of your dollars. So again, if you were making $50,000 a year and there was a 3% inflation, I'm just going to turn this auto step on. And what it shows you is that your $50,000 is buying less and less and less every single year. And so 25 years from now or 30 years from now, your $50,000 is only going to buy about $21,000 worth of stuff. To put a different way, if you needed to buy $50,000 worth of stuff 29 years from now, you're actually going to need about $118,000. That's the impact of inflation. And again, who does inflation hurt the most? People in the lower income brackets. So, as discussed, taxes play a huge impact on where you put your money, right? There's income taxes. And if you're putting money into that qualified plan, the income tax bracket is going to matter, not only today, but well into the future. And our government, remember, they don't make any money, they take our money. But when they can't take enough of our money, what we're finding now is that they print more money. And when they print more money, that's causing inflation. Inflation drives up the purchasing or drives up the cost of things and makes our money less valuable. So we have to protect ourselves and we have to prepare for this. And this is why we're trying to give you better information so you can make better decisions for your financial future.
100%. I think beyond everything, I think people can tangibly feel inflation. A lot of the concepts we're talking about
Oh, yeah.
might seem a little ethereal if you're new to this. Maybe you've never investigated any of these things. And so as with anything, whenever something is completely new, it may not feel like it hits home as much. But I definitely think right now, more than ever this year, inflation is something that we are all feeling. And at least now,
Right.
having seen this class from you, Monica, people are going to have a better understanding about why they feel that squeeze and where that's coming from.
Right.
It's not coming out of thin air. It's happening from a lot of trickle down consequences from actions that, the people in charge are taking. So I think this is
Right.
extremely, extremely impactful, educational. And I really, like I said before, hope this opens people's eyes and encourages people to get motivated enough to research this and really think about this. I also wanted to add, it's not something, it's funny because Monica, you and I talk about this a lot where, I'm a very high anxiety person. And a lot of times when I start thinking about these things or I start looking at my financials or whatever, it's immediately doomsday, right? We were just talking about, how our brains work. And when you're an analytical person, usually you default to doomsday and you get kind of anxious and scared. And I just wanted to share that, for people that are going through that experience, you're not alone. I go through that myself. Monica, you go through that yourself too. And so this is something that I
Regularly
don't want
with
people to be,
clients.
I don't want people to be scared of it. It is going to feel scary. But that's because it's uncharted territory, not because it's really horrifying. And I can tell you from personal experience that the moment you take accountability and ownership over your financial
Oh,
situation,
with that.
all of that fear goes out the window because I feel like the fear is based on, trying to create a response to something we don't understand or we don't know. Once you understand it, it's no longer a fear-based thing, it's an action-based thing. So I just wanted to add that little bit of, just kind of personal anecdote on that because I do know for a lot of people watching this, it is going to be, a lot of this is going to be scary, but I think it's a really, really good reason to be scared and to overcome.
Well, and I want people to understand too, if you truly understand inflation and you understand inflation's eroding the purchasing power of your dollar today is the most valuable dollar that you're ever going to have. So we want to be smart with our money today. The reason we talk about taxation and understanding taxation is why would you put your money someplace that's never been taxed if we think we're in the lowest tax bracket we're ever going to be in today? So if I know that my income is going to go higher over the years, and if you're 20, 30, 40 years old, it will. Your best economic earning time is in your 40s and 50s. Why would I hide my money away in a government savings plan where I can't touch the money? It's fully at risk. Why would I do that? Right. So
Right.
these are there's a why. Like, I'm teaching you how to fish. I want to help you understand the why. Would I not recommend you putting money in a qualified plan instead of just saying don't put money in a qualified plan? Because today every CPA is going to say put money in a qualified plan. Why do they do that? They do that because they save you taxes this year, not 5, 10, 15, 20 years down the road, but today. And today is not what we're living for necessarily, right? We have to live for today with an eye on the future.
Right.
So education will empower you to make better decisions with today's dollars.
Yep. And I love how all of this, if everyone's paying attention from class 1 all the way today to class 4, all of this stuff actually interrelates, right? So talking about what we're doing with each dollar that we have and where we're putting that, also not only from the investment side, right? But we already talked about the spending part of it too. So, just to kind of bring it all together, obviously there's a theme of strategy, there's a pattern here, and I really hope people are catching on to that, because that is really the nuts and bolts of financial success, in my humble opinion.
Right. Well, in our next class, great segue into our next class, we're going to be talking about investment accounts or savings accounts that we do with after-tax dollars. So maybe the right thing to do is to pay our taxes today because we think taxes are low, and then invest those dollars in taxable vehicles or tax-free vehicles. So we're going to get into that next week, and all the different possibilities of where to put that future savings money. Like I said, last week we talked about risk. This week we talked about taxes and qualified plans. And next week we're going to go ahead and talk about brokerage accounts, or what we call after-tax investments.
Very cool. Wonderful class. I mean, I cannot say that enough. I mean, this stuff is so impactful. I just hope everyone is really getting a lot out of this, because there's so much here to digest. And thank you again for another wonderful class and wonderful explanation. And as always, everyone, we really encourage you to engage with us and take full advantage of this opportunity. With Monica being here on my channel, I would really encourage you guys to leave comments below this video, ask questions, and get the most out of all of this information. If you have anything that maybe you don't want to post in a public forum like YouTube, you can absolutely send an email to support@theneilhub.com. I will collect all of those questions, leave you anonymous, and that will allow us to include those in our office hours. So if you want to engage more, definitely participate by leaving us questions, comments, and all of that good stuff. And we look forward to doing class 5 next time. All right. Thanks,
Thank you.
Monica. Bye.
Bye-bye.